Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. Inflation has been soaring, the Federal Reserve has been tightening monetary policy, and as a result, we've seen the stock market move down dramatically from its all-time high. We've seen the Treasury bond market absolutely collapse over the past few months. So the typical 60-40 portfolio that's really been working extremely well since 1982, right? 1982 right here, that was the beginning of the 60-40 bull market where we've seen stocks and bonds both perform extremely well and provide massive returns to investors who have been invested in these asset classes. And this inflation shock that we've had here over the past year seem to have brought this trend to an abrupt end. And a lot of people are talking about a bear market right now, both in terms of the stock market and the bond market, in a similar fashion to what was happening in the 70s right here, where you had this inflation shock, and all of a sudden, what was initially a massive bull market here turned into a 20-year period of consolidation in the stock market, with bond prices absolutely collapsing. So that possibly is something that's in store for us for the next decade. But our thinking right now is that we're actually coming towards the end of this first inflation shock. And I say first because, who knows, we might have several shocks like we had in the 1970s, lots of price instability. But in the short term, we expect that a relief of these inflationary forces should bring a lot of optimism back to the 60-40 mix that's been extremely beat up over the past few months throughout 2022, really. So in this video, we're going to take a look at the short-term tactical developments, what's going on in the market, what's going on underneath the surface, if we are actually seeing material evidence that this shift is actually occurring. And then I want to take a trip back in history to another period where inflation was extremely volatile, where prices were not stable, and look at an episode back then and what was happening to the stock market back here that'll perhaps give you a different perspective to this example of the 1970s. Now, if you are interested in following these crazy markets with us, make sure to smash that subscribe button. Also, don't forget to click on that like button if you enjoy watching these videos, if you enjoy the effort and the time that goes into making these episodes. Also, if you have a comment, if you have a feedback, make sure to leave it in the comments section down below. We appreciate all the comments, whether that's support or objective criticism on the research that we're bringing to the table. We love to participate in the public discussion, in the public debate. We think it's healthy to have different opinions, so it is really appreciated as long as it's brought in a respectful manner. And now, without further ado, let's get right into it. Let's dive into the short-term technicals. Here I have the 50-day moving average pointing down, still clearly in a downtrend. So we have not seen improvement in terms of the direction of the S&P 500. There's still lots of work to do. We're still in a downtrend and we need to be objective about that. But these are the big levels that we're looking at right now. This neckline resistance here, head and shoulder neckline, this price channel that you see right there, capturing some of these big resistance levels and also some of the big support levels right here. So if we start breaking all of these levels in an impulsive manner, that's a bullish setup right here, right? Breaking the 50-day moving average, breaking that bearish price channel, breaking back above the neckline, that would be a bullish setup and a big improvement in the technical picture to see that type of move. The big level of support right now just below us is around 3,540 points, which would also correspond to this head and shoulder target, right? You take the measured target from the head and shoulder pattern, take it from the break, and that takes you around to the 3,540 points. So that would be around the measured target for the head and shoulder pattern. We'll see if we get there, right? I'm seeing a lot of people online calling for a capitulation move before the market moves higher. right? And in my experience, I've seen the market bottom very, very often when a lot of people are calling for more capitulation, right? So just be aware of that. Be aware of the fact that when you're seeing a bunch of people call for more capitulation online, they don't have a crystal ball, and you really shouldn't be following the consensus. I think it would be a pain trade for the market to bottom here. I think a lot of people are waiting for these levels of support to be hit before stepping back into the market, and I think that would be very obvious. In my opinion, but objectively it is support. Now, if I take a look at what's going on in the break-even inflation market, we can clearly see that inflation expectations are moving down very rapidly here, right? That was the peak in March following the Russian invasion of Ukraine. Peak inflation, and here we're coming down rapidly in terms of the expectations of inflation, and we're down to the same level as we were at in July 2021. So the market right now is beginning to anticipate a rollover in inflation. If we take a look at how that compares to the actual inflation rate, you can see it's a pretty good coincident indicator of where inflation is going, right? Break-even inflation rates don't usually tend to derive too far away from where actual CPI is heading, especially in 2021 here, where it was a good leading indicator of inflation. You had inflation break-even rates spike before, much before the actual surge in inflation. By the time you had inflation start to pick up, break-even inflation rates were already pricing in a major breakout in inflation. So today we have inflation at 8.6% for the month of May, but break-even inflation rates are telling you that perhaps we should be open to the idea that inflation is going to start rolling over, and rolling over in a big way. Not just slowly rolling over, but actually collapsing back down, which is really what we've been talking about for the past couple of months. We've been anticipating this move back down in inflation, very aggressive disinflation that's going to take a lot of people by surprise. And it hasn't materialized yet, but this is really the first step to seeing that. And we can also take a look at the commodities market. Let me put up the Bloomberg commodity ETF. That's highly correlated to inflation as well. Inflation is basically a function of commodities. As the price of raw materials goes up, inflation rates go up, right? It makes sense, especially when you take into account how much oil prices have been contributing to the motor fuel CPI component, right? It's been a massive surge in how much oil prices have contributed to actual CPI, right? This is a chart that we produced in an article just a couple of weeks ago. And same thing right here, you can see motor fuels volatility. So oil's volatility is just not comparable to any other components of the CPI. So although energy or oil or motor fuel is not a big part of CPI, it's so volatile that it does end up having a massive influence on CPI. And so that's pretty much the most important thing to look at. That's why we're very closely watching the commodity markets, which are primarily composed of oil. But you can see here they peaked. Guess where they peaked? They peaked towards the end of May here, or beginning of June, right as we had that 8.6% CPI reading in the US, right? And since then, commodities have come down pretty significantly, almost back to the place they were before the invasion of Ukraine, which you could say was in around January, February, when inflation was at 7%. So, we'll see if that trend continues to materialize. But this is something that the market could get optimistic about in the short term, and could be why we don't see that final capitulation, right? So, we're staying open-minded. We're ready in the event where we do see that final capitulation, but it's not a guarantee. Nothing's a guarantee in the market. One thing that is guaranteed is the fact that we're striving every day to provide the best quality research and the best service to gain an investment or trading edge on gameoftrades.net. We're completely redesigning our investment and trading strategy to make it easier for you guys to follow, easier for you guys to get those entries at the right moments, to understand the broader macro environment and how to take advantage of it. We really want to make the research as actionable as possible. So we recently opened an investment setup on the consumer discretionary sector where we laid out the entire investment case, the entire bullish macro outlook for the sector. And now the idea is to give regular tactical updates on this sector that takes a look at the risk reward every couple of weeks and identify if it's a buy opportunity, where are the right support levels to enter, resistance levels to exit, is the trade going out, is the trade playing out as we're expecting it, and really take you through that entire process. That's a big aspect that we're working on our service, is making these trade and investment ideas as clear as possible and as actionable as possible for you guys. So now let's go back in history. Let's go back to the 1940s. And this is a period of time that we've done a lot of work on over the past few weeks, because it's another one of those historical periods where we saw inflation running out of control. We had multiple inflation shocks in the 1940s, very similar to the period that we saw in the 1970s. Now, a lot of investors look back to the 1970s as an example to what could happen today, but I think that in order to have a broader view of what's going on in the market, we need to go back further and understand this period just as much as the 1970s and see which one is more similar to today. And there's a specific episode I want to take a look at, and that is 1946 right here. This massive spike in inflation where inflation surged up to 20%. Now just think about the context behind this spike. This was just after World War II, during a period where you had a lot of government stimulus, a lot of debt that was printed, and it created this boom in consumer spending. In fact, I can show you very clearly on this chart here. This is a chart that goes back to the 1930s. So this is real personal spending on goods. And you can see what happened post-COVID. We had this massive spike in spending on goods. It was driven by stimulus. It was driven by the reopening. And you can see what that triggered. These gray bars are the CPI. This real spending on goods surged and created this spike in CPI. Now, if we take a look at the last time that we saw such a big surge in real spending on goods, we have to go back to 1945. Right after the war, a massive, massive surge in real spending on goods. And guess what followed? Just a few months later, a massive spike in CPI. Right, so you can already see a big similarity between what was happening here in 1946 to what's been happening here. And you can see what happened following that spike. You just had a crash in the real spending on goods, back to rebalancing, seeing all that spending coming back down and rebalancing. Now let's check out how the market behaved throughout this period. It was very strong in 1945 as you had that big spending boom. And in fact, if we take a look at the S&P 500 PE ratios during that 1944 to 1945 period, PE ratios spiked massively from around 14 all the way to 23. Now, of course, we know that's very similar to today. We know that the stock market has been incredibly strong with that boom in consumer spending that followed the reopening and lots of stimulus. And if we take a look at PE ratios throughout this period, you had a boom in PE ratios, unbelievable valuations. But if we go back to 1946, look at what happened to the stock market when inflation appeared. You had consumer spending collapse, inflation surge, and you had the stock market correct violently here. And if we take a look at how the stock market performed from that top, this was a 25% correction. Now in 2022, we've had a 25% correction as well. When did the market bottom in 1946? It bottomed when inflation peaked here. Now what followed was very different because we then proceeded to go into deflation, and so the market started to get worried about deflation and potentially going back into a depression like the 1930s, and so the market only rallied once that concern was behind. But if you take a look at the unemployment rate in 1946, you can see we did have a recession, right? This is a gray bar, so it was a recession as you you had that pullback in consumer spending, but the unemployment rate barely moved higher. It moved from 1.5% to 3%, and then it stayed flat. And if we take a look at earnings per share, so how much companies were making throughout this period, we saw earnings move up massively throughout this period, right? So I'm not saying this is exactly what's going to happen, but I think investors should be open to the idea that this market environment is substantially different to anything that we've seen throughout the past 20 years, and perhaps does look something like what we saw in the post-war period. Perhaps that there are some similarities in terms of the market dynamics of what we're seeing to the post-war period. Now, of course, there's lots of differences between now and what was going on in the 1940s, but this is just another example of disinflation being generally a good thing for the market. We've seen that again and again throughout history. Disinflation tends to correspond to market bottoms. We've rarely seen disinflation be bad for the market. In 1946 is another example of that, where we can also draw quite a few similarities in terms of the dynamic of consumer spending. So hopefully you guys enjoyed this episode. Don't forget to smash the like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.